Hello and welcome. If you're listening to this, chances are you or someone you know is familiar with the feeling that comes with a formal letter from the Internal Revenue Service, or the IRS. It's a moment that can bring a wave of anxiety and uncertainty. The language is official, the implications seem serious, and suddenly, you're faced with a problem you may not know how to solve. You are not alone. Millions of Americans face challenges with their taxes every year for a wide variety of reasons. This series is designed to be your comprehensive guide to understanding this complex world. We will demystify the process, explain the roles of the professionals who can help, and empower you with knowledge about the paths to resolution. Before we proceed, it is essential to state that the information provided in this entire series is for educational and informational purposes only. It does not constitute legal, financial, or tax advice. The tax code is incredibly complex and individual situations vary greatly. You should always consult with a qualified and licensed professional, such as a tax attorney or a certified public accountant, for advice tailored to your specific circumstances. Our journey begins with the foundational question: how do tax problems start? For most people, it's not due to a deliberate choice to avoid paying taxes. More often, it stems from life's unexpected turns. Perhaps it was a period of unemployment or reduced income, making it impossible to cover the tax bill. It could be the result of a costly medical emergency that drains savings. For small business owners or freelancers, it might be a simple miscalculation of quarterly estimated taxes, or a sudden downturn in business that left no funds to pay what was owed. Sometimes, it's a divorce, an inheritance, or another significant life event that complicates an otherwise straightforward tax situation. When taxes go unpaid, the initial amount owed begins to grow. The IRS is legally required to assess penalties and interest on the outstanding balance. There are penalties for failure to file on time, failure to pay on time, and for underpayment. Interest can also accrue on the unpaid balance, and it can compound daily. Over months or years, a manageable tax debt can balloon into a seemingly insurmountable figure. This is the point where stress and fear can become overwhelming, and the path forward seems unclear. People often feel trapped, worried about potential consequences like wage garnishment, bank levies, or liens on their property. This is precisely where the concept of tax relief enters the picture. The term itself can sometimes sound too good to be true, but it is a legitimate area of tax law. Tax relief does not mean illegally evading taxes. Instead, it refers to the various programs and strategies established by the IRS itself to help taxpayers who are genuinely unable to pay their full tax debt. The IRS understands that financial hardship is real, and its primary goal is ultimately to collect what is owed in a way that is manageable for the taxpayer and feasible for the government. They would rather work out a solution to receive some or all of the tax debt over time than receive nothing at all from a taxpayer forced into financial ruin. So, what does this relief look like in practice? It comes in several forms, which we will explore in great detail in later chapters. These can include setting up an installment agreement, which allows you to pay your debt over an extended period. Another option might be an offer in compromise, where the IRS agrees to accept a lower amount than what you originally owed, based on a thorough review of your financial situation. In some cases, a taxpayer might be declared currently not collectible, which temporarily suspends collection efforts due to severe financial hardship. Navigating these options is not simple. Each program has strict eligibility requirements, extensive paperwork, and detailed financial disclosures. This is where a tax relief advocate becomes an essential ally. So who exactly is a tax relief advocate? The term advocate is a broad one. It refers to a qualified professional who represents you and acts on your behalf before the IRS. They are your intermediary, your negotiator, and your guide. Crucially, not just anyone can represent you. The IRS has specific rules about who has the authority to do so. These professionals typically fall into one of three categories: certified public accountants (CPAs), tax attorneys, and enrolled agents (EAs). Each of these professionals has a deep understanding of tax law, IRS procedures, and the specific requirements for relief programs. Their primary role is to lift the burden from your shoulders. They handle the direct communication with the IRS, which alone can significantly reduce stress. They know the right forms to file, the right information to provide, and the right questions to ask. They will analyze your entire financial picture, your income, expenses, assets, and liabilities, to determine the most viable path forward for your specific situation. Think of them as a translator and a strategist. They translate the complex language of the IRS into terms you can understand, and they develop a strategy to present your case in the most favorable light, while remaining completely within the bounds of the law and ethical practice. They advocate for your best interests, aiming to secure a resolution that you can realistically manage, allowing you to settle your debt and get a fresh financial start. Over the next 14 chapters, we will break down every aspect of this process. We will explore the different types of tax professionals in detail, so you can understand who might be the best fit for you. We will walk through each of the major tax relief programs, explaining how they work, who qualifies, and what to expect. We will discuss your rights as a taxpayer, how to deal with collection actions, and how to stay compliant in the future. By the end of this series, our goal is for you to feel informed, not intimidated. The existence of a tax problem is not a final judgment on your financial life. It is a problem to be solved, and with the right knowledge and the right professional help, it can be. Thank you for joining me for this first chapter. We've laid the groundwork by understanding how tax problems arise and introducing the vital role of the tax relief advocate. Welcome back. In our first chapter, we introduced the concept of tax relief and the idea of having a professional advocate on your side. We established that facing the IRS doesn't have to be a solitary journey, but that leads to a critical question. Who exactly are these advocates? When you search for tax help, you'll encounter a variety of titles and credentials. Understanding the differences between them is the first step in making an informed decision for your situation. Today, we're pulling back the curtain on the 3 types of professionals who are federally authorized to provide unlimited representation to any taxpayer before the IRS: enrolled agents, certified public accountants, and tax attorneys. As always, let's remember that this information is for educational purposes. Choosing a representative is a significant financial decision, and this guide is intended to help you understand your options, not to endorse any specific professional or path. Your unique situation will ultimately determine the best fit for you. Let's begin with a group of specialists you may not have heard of before: enrolled agents, or EAs. An enrolled agent is a tax professional who has earned the privilege of representing taxpayers before the IRS by passing a comprehensive, 3-part examination covering all aspects of the tax code, from individual and business taxes to representation and ethics. Alternatively, they can earn this status through specific experience working at the IRS. What makes enrolled agents unique is that their expertise is exclusively in taxation. Their license is earned directly from the United States Department of the Treasury. Because it's a federal designation, an enrolled agent can represent any taxpayer in any state. They are, in essence, America's tax experts. Think of an EA as a specialist, much like a cardiologist is a specialist in heart health. While a general practitioner has broad medical knowledge, a cardiologist has deep, focused expertise in one area. Similarly, while other financial professionals may understand taxes, an EA's entire professional life revolves around the tax code, its complexities, and the procedures of the IRS. They are required to complete 72 hours of continuing education every 3 years to maintain their license, ensuring they are always up to date on the ever-changing landscape of tax law. For many common tax debt situations, an enrolled agent's focused knowledge is precisely what's needed to navigate IRS collections and programs effectively. Next, let's discuss a more familiar title: the Certified Public Accountant, or CPA. A CPA is a trusted financial advisor for individuals and businesses alike. To become a CPA, an individual must pass the rigorous uniform CPA examination, meet extensive education and experience requirements, and be licensed by their specific state's Board of Accountancy. Unlike enrolled agents whose license is federal, a CPA's license is state-specific, though most states have reciprocity agreements. The expertise of a CPA is generally broader than that of an EA. Their training covers not just taxation, but also auditing, financial planning, business valuation, and general accounting. This wide-ranging financial acumen can be incredibly valuable, especially when a tax problem is deeply intertwined with complex business finances or inaccurate bookkeeping from prior years. A CPA is exceptionally skilled at digging into financial records, reconstructing incomplete books, and preparing accurate, amended tax returns that form the foundation of any tax relief case. If your tax issues stem from complex business operations, multiple income streams, or disorganized financial records, the comprehensive financial skills of a CPA can be a significant asset. Finally, we have the tax attorney. A tax attorney is first and foremost a lawyer. They have graduated from law school and have passed a state bar examination, which qualifies them to practice law in that state. Their specialization is in the application of tax law. While EAs and CPAs can represent you before the IRS in administrative matters, only an attorney can represent you in a court of law, such as the U.S. Tax Court. This legal background provides a distinct advantage in certain situations. Tax attorneys are experts in legal interpretation, precedent, and argumentation. Their involvement is particularly critical if a tax case involves potential criminal charges, such as tax evasion or fraud, as they can provide legal defense. Furthermore, communications with a tax attorney are protected by attorney-client privilege, a legal concept that protects confidential communications from being disclosed. This privilege is generally stronger and broader than the limited confidentiality that applies to CPAs and EAs. If your case is legally complex, involves a dispute over the interpretation of a law, or has the potential to end up in court, a tax attorney is the appropriate choice. So how do you choose? There is no single best option. The right choice depends on the nature of your problem. If your issue is a complex but straightforward tax debt case requiring negotiation with the IRS for a resolution like an installment agreement or an offer in compromise, the deep tax-specific knowledge of an enrolled agent is often a perfect match. If your problem is rooted in disorganized or complex financial records from a business, or if you need to file multiple years of delinquent returns with precise accounting, the broad financial expertise of a CPA could be invaluable. And if your case involves serious legal disputes, potential criminal investigations, or requires a battle in tax court, the legal authority and protections offered by a tax attorney are indispensable. It's also important to note that many tax relief firms employ all three types of professionals, allowing them to work as a team on your case. The most important factor is not the title itself, but the professional's specific experience with tax resolution cases, just like yours. We've now clarified who the key players are in the world of tax relief. You understand the unique strengths that enrolled agents, CPAs, and tax attorneys bring to the table. This knowledge is your first tool in navigating the path to resolving your tax issues. Welcome back to our guide on navigating the world of tax relief. In our last chapter, we identified the key professionals who can help you: enrolled agents, CPAs, and tax attorneys. Knowing who they are is one thing, but taking that first step to actually speak with one can feel daunting. This is why today, we are focusing entirely on the initial consultation. This first conversation is arguably one of the most important steps in your entire journey. It's not just a sales call. It's a two-way interview where you determine if a firm is right for you, and they determine if they can genuinely help. Our goal is to demystify this process so you can enter that conversation with confidence. As we begin, please remember that this discussion is for informational purposes only and is not a substitute for professional advice. The goal here is to prepare you for a productive conversation with a qualified tax professional who can analyze your personal situation. So, you found a potential tax relief firm or professional, and you're ready to make the call. What now? The process can be broken down into 3 phases: your preparation before the call, what to expect during the call, and the critical questions you should ask. Let's start with phase 1. How to prepare. Proper preparation can make the difference between a vague, confusing call and a highly productive one. First, try to gather any relevant documents you have. This doesn't need to be a perfectly organized archive, but having key pieces of information on hand is incredibly helpful. The most important documents are any recent notices or letters you have received from the IRS. These letters contain specific codes, dates, and figures that will tell a professional exactly where you are in the collections process. If you have them, also locate copies of the tax returns for the years in question, even if they are unfiled drafts. Next, be prepared to talk about your financial situation. The professional will need to understand your current financial reality to see which IRS programs you might qualify for. This means having a general idea of your monthly household income from all sources, as well as your essential living expenses, like housing, utilities, food, and transportation. You don't need a perfect spreadsheet, but a realistic overview is key. Finally, and perhaps most importantly, be prepared to tell your story. How did the tax debt happen? Was it a job loss, a medical issue, a business failure? Being open and honest is crucial. A reputable professional is not there to judge you. They are there to understand the full context of your situation, so they can build the strongest possible case on your behalf. Understanding the why behind the debt can be a critical factor in negotiating with the IRS. Now for phase 2. What to expect during the consultation. You can expect the consultant to do 2 main things: listen and ask questions. A good initial consultation should begin with them listening to your story. They will want to hear, in your words, what happened and what your primary concerns are. After they have a basic understanding, they will begin to ask very specific questions. They will ask about the notices you've received, the total amount the IRS says you owe, and which tax years are involved. They will ask about your income, your assets, like your home, cars and bank accounts, and your monthly expenses. This might feel invasive, but it is absolutely necessary. The eligibility for nearly all IRS relief programs, like the Offer in Compromise, is based on a strict mathematical formula that calculates your ability to pay. Without this financial information, it is impossible for them to give you an accurate assessment of your options. A reputable professional will not make unrealistic promises on this first call. They will not guarantee they can settle your debt for pennies on the dollar. Instead, they should explain the different potential paths you could take. Based on the information you've provided, they might say something like, "It seems you may be a candidate for an installment agreement, or we could investigate your eligibility for an offer in compromise." They will explain the process, the potential outcomes, and the next steps involved. They are there to present possibilities, not to guarantee results. This brings us to Phase 3, critical questions you must ask. Remember, you are interviewing them as much as they are assessing you. You need to be a savvy consumer. Here are some essential questions to ask any firm you are considering. First, who exactly will be handling my case, and what are their qualifications? Will you be working with an enrolled agent, a CPA, or a tax attorney? You have a right to know the credentials of the person who will be speaking to the IRS on your behalf. Second, what are your fees and how are they structured? Reputable firms will be transparent about their pricing. Is it a flat fee or an hourly rate? What does the fee cover? Are there separate fees for different stages of the process? Be very wary of any firm that is vague about costs. Third, how will you keep me updated on the status of my case? Communication is key. Will you have a dedicated point of contact? Will you receive regular updates by email or phone? Understanding the communication process up front can prevent a lot of frustration later. And finally, what are the potential risks or downsides of the options you've described? A trustworthy advisor will give you the full picture, including the potential negatives. They should be honest about the chances of success and what could happen if a certain strategy doesn't work out. By preparing for the call, understanding what will happen, and asking the right questions, you transform the initial consultation from a moment of anxiety into an act of empowerment. You are taking control of your situation by gathering the information you need to make the best possible choice for your future. Hello and welcome back. In our journey so far, we've discussed the nature of tax problems, the professionals who can help, and how to approach your first consultation. In each of these steps, there's an underlying theme of process and procedure. It's crucial to understand that dealing with the IRS is not an arbitrary battle. It's a structured process governed by law, and you as a taxpayer have fundamental rights that are protected throughout that process. Today we are going to explore what those rights are. This knowledge is your shield. It ensures you are treated fairly and with dignity, and it is the foundation upon which your advocate will build your case. As a reminder, our discussion today is purely for educational purposes, designed to empower you with an understanding of the established rights every taxpayer possesses. In 2014, the IRS formally adopted a Taxpayer Bill of Rights, taking 10 fundamental principles from the existing tax code and grouping them into one clear document. This document, officially known as IRS Publication 1, serves as a cornerstone of modern tax administration. Let's walk through each of these 10 rights, one by one, and explain what they mean for you in practical terms. First is the right to be informed. This is the most basic right. It means you have the right to know what you need to do to comply with the tax laws. Any notice, letter, or form from the IRS should be clear and easy to understand. They must explain their decisions about your tax account and the reasons behind them. For example, if the IRS sends you a notice that you owe more tax, that notice must clearly explain why they believe you owe it, breaking down the tax, penalties, and interest. Second, you have the right to quality service. This means you have the right to receive prompt, courteous, and professional assistance from the IRS. You have the right to speak to a supervisor if you feel you are receiving inadequate service. This right ensures that the process is professional and respectful, not intimidating or hostile. Third is the right to pay no more than the correct amount of tax. This is a critical one. You are only obligated to pay the amount of tax that is legally due, and nothing more. If you've overpaid, you have the right to a refund. If the IRS makes a mathematical error, you have the right to have it corrected. This right is the entire basis for challenging an incorrect assessment from the IRS. Fourth, you have the right to challenge the IRS's position and be heard. This means you can disagree with the IRS, and you have the right to provide additional documentation and evidence to support your position. The IRS is obligated to consider your objections fairly and promptly. This isn't a one-way street where the IRS simply dictates terms. It is a process that includes your side of the story. This leads directly to the fifth right: the right to appeal an IRS decision in an independent forum. If you disagree with an IRS decision, you generally have the right to a fair and impartial administrative appeal. This is handled by the IRS Office of Appeals, which is a separate division within the IRS. This ensures that a fresh pair of eyes reviews your case. You also generally have the right to take your case to court. Sixth is the right to finality. This right provides closure. It means you have the right to know the latest date you can challenge an IRS decision, and also the latest date the IRS has to audit a particular tax year or collect a tax debt. These time limits, known as statutes of limitations, prevent a tax issue from hanging over your head indefinitely. Seventh, you have the right to privacy. This means you have the right to expect that any IRS inquiry or examination will be no more intrusive than necessary. They cannot go on a baseless fishing expedition into your personal affairs. Their actions must comply with the law and respect your due process rights. Eighth is the right to confidentiality. This is closely related to privacy. You have the right to expect that any information you provide to the IRS will be kept confidential and will not be disclosed to others unless authorized by you or by law. There are strict penalties for IRS employees or tax preparers who wrongfully disclose your information. Ninth, and critically important to our discussion, is the right to retain representation. You have the right to hire an authorized professional, like an enrolled agent, CPA, or tax attorney, to represent you in your dealings with the IRS. Once you have formally authorized a representative, the IRS must generally work directly with them, not you. This right allows you to put a professional buffer between yourself and the IRS. Finally, the 10th right is the right to a fair and just tax system. This is a broader right which states that you can expect the tax system to consider all facts and circumstances that might affect your ability to pay or provide information on time. This right gives the IRS the flexibility to help taxpayers facing financial hardship, and it is the philosophical basis for programs like the Offer and Compromise. These 10 rights are more than just words on a page. They are your protections. A qualified tax advocate knows these rights intimately. They use this knowledge to ensure that every form is filed correctly, every deadline is met, and every communication with the IRS is handled properly, all while ensuring your rights are upheld at every turn. Knowing your rights changes your perspective from one of fear to one of empowerment. Hello, and welcome back. In our previous chapters, we laid the essential groundwork for your journey. We've talked about the nature of tax problems, the professionals who can help, the importance of the first consultation, and the fundamental rights that protect you. Now, it's time to move from the theory into the practice. We will begin exploring the actual solutions the IRS offers, starting with the most common and straightforward option: the installment agreement. As we dive into the specifics of IRS programs, it is crucial to remember that this discussion is for educational purposes. Eligibility and terms can depend on many individual factors, and a qualified professional is the only one who can advise you on your specific circumstances. So, what exactly is an IRS installment agreement? At its core, it's a payment plan. It is a formal, legally binding agreement between you and the IRS that allows you to pay your full tax debt, including penalties and interest, over an extended period in monthly payments. This is a crucial first point. An installment agreement does not reduce the total amount of tax you owe. However, it does provide immediate relief by stopping more aggressive collection actions, like bank levies or wage garnishments, as long as you adhere to the terms. It provides a predictable, manageable way to resolve your debt and get back on track. Not all installment agreements are created equal. The type of agreement you may qualify for often depends on the total amount you owe. Let's break down the common tiers. For smaller debts, typically those under $10,000 in tax, there is the guaranteed installment agreement. The IRS is generally required to approve this plan if you meet a few key conditions. You've filed and paid all your taxes for the past 5 years. You haven't had an installment agreement in that time, and you agree to pay the balance in full within 3 years. This option is designed to be a simple, no-hassle resolution for smaller balances. The next level up is the streamlined installment agreement. This is one of the most common types. Generally, individual taxpayers who owe a combined total of $50,000 or less in tax, penalties, and interest can qualify. The term streamlined means the process is simplified, and the IRS typically does not require a detailed financial statement or proof of your monthly expenses. The payment term is usually up to 72 months, or 6 years. For many people with moderate tax debt, this provides a clear and achievable path to resolution. But what if you owe more than $50,000? This is where the process becomes more involved, and where a tax advocate becomes especially valuable. For these larger debts, you will likely need to apply for a non-streamlined or financially verified installment agreement. In this case, the IRS will not just grant a payment plan. They will want to determine exactly how much you can afford to pay each month. To do this, you'll be required to complete and submit a collection information statement, typically IRS Form 433-F. This form is a detailed snapshot of your entire financial life. You'll have to provide information on your income from all sources, your assets like bank accounts and property, and a full breakdown of your monthly living expenses. The IRS has national and local standards for what it considers an allowable living expense. They will subtract your allowable expenses from your income to determine your disposable income, and this figure will form the basis of your monthly payment. An experienced advocate is skilled at preparing these financial statements accurately and presenting your situation in a way that argues for a monthly payment that is realistic and sustainable for you. Regardless of the type of agreement, there are universal rules you must follow once it's in place. This is what we call living with an agreement. First and foremost, you must make every single monthly payment on time and in full. Missing a payment can cause your agreement to default, which could restart aggressive collection actions. Second, you must stay current with all future tax obligations. This means you must file all your future tax returns on time, and you must pay any new tax liability in full. You cannot accumulate new tax debt while paying off old debt. If you do, it will almost certainly cause a default. Finally, it's important to know that the IRS will automatically apply any future tax refunds you are due to your outstanding balance until it is paid in full. In summary, the installment agreement is a foundational tool in tax resolution. It provides breathing room and a structured path to becoming debt-free with the IRS. While the concept is simple, the rules, especially for larger balances, can be complex. Hello and welcome back. If you've ever heard late-night radio ads or seen online banners promising to settle your tax debt for pennies on the dollar, then you have already been introduced to the topic of today's chapter, the Offer in Compromise, or OIC. This is, without a doubt, the most talked about tax relief program, and for good reason. It is one of the only programs that can result in you paying the IRS a lower amount than you originally owed. However, it is also the most misunderstood. Today, our goal is to cut through the hype and give you a realistic, clear-eyed look at what an offer in compromise truly is, who it's for, and the difficult process involved in getting one approved. Let's begin with our essential reminder. This information is for educational purposes only. The Offer in Compromise program is incredibly complex, and the information here is a simplified overview. Only a qualified tax professional who has done a deep analysis of your finances can provide a reliable opinion on your potential eligibility. So, what is an offer in compromise? It is a formal agreement between a taxpayer and the IRS that resolves the taxpayer's debt for a lesser amount than the total originally owed. You might ask, why would the IRS ever agree to take less than what it is owed? The answer is simple: it's a pragmatic business decision. The IRS will only accept an OIC if they determine that the offer represents the most money they can reasonably expect to collect from you within a reasonable period of time. It is not a program for everyone, nor is it a simple loophole. It is a last resort option for taxpayers in significant financial distress. The IRS will generally only consider an OIC under one of three specific grounds. The first, and by far the most common, is called doubt as to collectability. This means that based on a thorough analysis of your financial situation, there is serious doubt that the IRS could ever collect the full amount of tax you owe. Your assets and income are simply not enough to cover the debt. The second, much less common ground, is doubt as to liability. This applies only when there is a genuine dispute over whether you legally owe the tax in the first place. This isn't about an inability to pay, it's about a legitimate argument that the tax was never correctly assessed. The third and rarest ground is effective tax administration. This is an exception made in cases where collecting the full amount would not necessarily create economic hardship, but it would be unfair, unjust, or inequitable. This is a very high bar to clear, and is reserved for exceptional circumstances.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
For the vast majority of people, an OIC is pursued under doubt as to collectability. To determine this, the IRS uses a strict and unforgiving formula to calculate what it calls your reasonable collection potential, or RCP. Your RCP is the magic number that dictates your eligibility and the minimum amount the IRS will accept. This formula is based on two key components. First, the net realizable value of your assets. The IRS will look at everything you own: your home, cars, bank accounts, retirement funds, and investments. They will determine their quick sale value and subtract any loans or liens against them to find the net equity. Second, your future disposable income. The IRS calculates your monthly income from all sources and then subtracts your allowable monthly living expenses. It's important to note that the IRS uses its own national and local standards for what constitutes an allowable expense, which may be less than what you actually spend. The resulting figure, your disposable income, is then multiplied by either 12 or 24, depending on the payment terms of your offer. Your reasonable collection potential is the sum of your asset equity plus your future disposable income. Your offer amount must, at a minimum, be equal to or greater than this calculated RCP. This is where the pennies on the dollar myth falls apart. If you have significant home equity or a high disposable income according to the IRS's math, you will not be a candidate for an OIC, even if you feel like you are struggling. The process itself is a marathon, not a sprint. It begins with filing extensive paperwork, including Form 656, the offer agreement itself, and Form 433, AOIC, a collection information statement that can be over a dozen pages long. You must also submit a non-refundable application fee and an initial, non-refundable payment toward your offer. Once submitted, your case will be assigned to an IRS investigator whose sole job is to scrutinize every detail of your financial life. They will verify your income, question your expenses, and validate the value of your assets. This process can take anywhere from 6 months to well over a year. There is often a period of negotiation, where your tax advocate will present arguments and documentation to support your case. In conclusion, while the offer in compromise is a life-changing solution for the small percentage of taxpayers who qualify, it is a difficult and invasive process with a high rejection rate. It is a powerful tool for those with genuine financial hardship, not a simple way out of a tax bill. Hello, and welcome back to our series. We have now explored two of the primary pathways to resolving tax debt. We discussed the installment agreement, which allows you to pay your debt in full over time. We also delved into the complex world of the offer in compromise, a program for settling your debt for less than you owe. But what happens if your financial situation is so severe that you cannot afford to do either? What if even a small monthly payment is simply impossible? For these situations, the IRS has a formal status known as currently not collectible, or CNC. Today we're going to explain what this status is, what it means for your tax debt, and who might qualify for this important form of temporary relief. As we discuss this topic, please remember our standard but crucial disclaimer. This information is for educational purposes. CNC status is granted based on a detailed IRS review of your specific financial hardship, and you should always consult with a qualified professional for guidance. Let's start by defining currently not collectible status. In the simplest terms, CNC is a declaration by the IRS that, at the present time, you do not have the financial ability to pay your tax debt. When your account is placed in CNC status, the IRS temporarily pauses active collection efforts. This means the threatening letters should stop, and you will be protected from immediate actions like bank levies or wage garnishments. It is, in effect, a pause button. However, it is critically important to understand what CNC status does not do. It does not eliminate your tax debt. The total amount you owe will continue to exist. Furthermore, penalties and interest will continue to accrue on the outstanding balance, meaning the total debt will actually grow larger while you are in CNC status. Additionally, the IRS will automatically seize any future tax refunds you are owed and apply them to your debt until it is paid in full. CNC is a shield from collection, not a forgiveness of the debt itself. So who qualifies for this status? Eligibility is determined by the same kind of in-depth financial analysis required for a non-streamlined installment agreement or an offer in compromise. You will need to submit a collection information statement, Form 433-F, along with supporting documentation like pay stubs, bank statements, and proof of your expenses. The IRS will review your total monthly income and compare it to your total allowable monthly living expenses, using their own national and local standards. If this calculation shows that your necessary expenses are equal to or greater than your income, leaving you with zero or negative disposable income, the IRS may grant you CNC status. You must prove to them that you cannot pay your basic living expenses and also pay your back taxes. The temporary nature of CNC status cannot be overstated. The IRS will periodically review your situation, often on an annual or biannual basis. They do this by looking at the income information reported on the tax returns you file each year. If your income increases to a point where their formula shows you now have the ability to make payments, they will remove your account from CNC status and expect you to set up a payment plan. This is where another critical concept comes into play: the collection statute expiration date, or CSED. The IRS generally has 10 years from the date a tax is assessed to collect it. After that 10-year period, the debt is legally extinguished. One of the most significant aspects of CNC status is that while your account is on pause, this 10-year clock continues to tick. For a person who remains in a state of severe financial hardship for many years, it is possible for the CSED to expire while they are in CNC status, effectively eliminating the debt forever. This is not a strategy, but rather a potential outcome for those with long-term, verifiable financial difficulties. Given the detailed financial disclosures required, having a professional advocate can be incredibly helpful when seeking CNC status. They can ensure your collection information statement is filled out accurately and completely, and they know how to properly categorize your expenses according to IRS standards, presenting the strongest possible case for your hardship. In summary, currently not collectible status is a vital safety net. It provides immediate relief from the stress of active collections for those who are truly unable to pay. It is a temporary pause, not a permanent solution, but for some it provides the breathing room needed to survive a financial crisis. Hello and welcome back. Over the last 3 chapters, we have explored the primary solutions available to taxpayers in distress: paying over time with an installment agreement, settling for less with an offer in compromise, and pausing collections through currently not collectible status. But to fully understand why these solutions are so vital, we must also understand the alternative. What happens when a tax debt is ignored? Today we will discuss the 2 most powerful collection tools in the IRS's toolkit: the federal tax lien and the IRS levy. Understanding these is not meant to cause fear, but to underscore the importance of being proactive. As always, please remember this is an educational overview. The legal implications of liens and levies are significant, and this information is not a substitute for advice from a qualified legal or tax professional. Let's start with the federal tax lien. A lien is not a seizure of property. Rather, a tax lien is a legal claim the government places on all of your property and rights to property, both real and personal. Think of it as the IRS securing its interest in your assets as collateral for the debt you owe. This action happens automatically by law after 3 conditions are met. First, the IRS assesses your tax liability. Second, they send you a bill, officially called a notice and demand for payment. And third, you fail to pay the debt in full by the deadline. Initially, this is a secret lien between you and the IRS. However, to protect the government's interest against other creditors, the IRS typically files a public document called a Notice of Federal Tax Lien. This notice is filed in local public records, and it alerts the world, including banks, lenders, and credit reporting agencies, that you have a debt to the government. The consequences of a filed tax lien can be severe. It attaches to all your assets, including property you acquire after the lien is filed. It can devastate your credit score, making it extremely difficult to get a loan, a mortgage, or a new credit card. If you try to sell your home or another major asset, the lien generally must be paid off from the proceeds before you receive any money. It is a powerful, long-lasting claim that secures the government's position as a creditor. Now let's talk about the levy. If a lien is the legal claim on your property, a levy is the legal seizure of that property to satisfy the tax debt. A levy is a much more aggressive and immediate action. The IRS does not just levy property out of the blue. They are required by law to follow a strict procedure, which includes sending you a final warning letter. This is typically called a final notice of intent to levy and notice of your right to a hearing. This letter is usually sent by certified mail and gives you 30 days to either pay the debt or make other arrangements before the IRS can begin seizing assets. This 30-day window is a critical opportunity to act. It's your chance to request a hearing or work with a representative to set up one of the resolution plans we've already discussed. If you don't respond, the IRS can proceed with a levy. The most common types of levies are on financial assets. A wage garnishment is when the IRS instructs your employer to send a significant portion of your paycheck directly to the government. The amount is not a small percentage. It's everything you earn above a legally exempt amount, which is a calculated figure based on your filing status and dependents. A bank levy is when the IRS seizes funds directly from your checking or savings account. They will freeze your account up to the amount you owe. And if you do not resolve the issue within 21 days, the bank is required to send the funds to the IRS. In more extreme and rare cases, the IRS can also levy and seize physical assets, like your car, boat, or even your home. So, how do you deal with these powerful tools? The simple answer is that the solutions we've been discussing are the cure. Entering into an installment agreement, having an offer in compromise accepted, or being placed in currently not collectible status will all stop a levy from happening. These actions are the formal arrangements the IRS is looking for. Once a resolution is in place and the tax debt is eventually paid, the IRS will issue a lien release, officially removing the government's claim on your property. In summary, liens and levies are the serious consequences of inaction. They are legally grounded, procedural, and are preceded by numerous notices and opportunities to act. They are the primary reason why it is so important to face a tax problem head-on with the help of a professional. Hello and welcome back. In our series so far, we have covered the universal principles of tax problems and their solutions. Today we are going to focus on a group that is a powerful engine of the American economy, but also uniquely vulnerable to tax issues: the self-employed. This includes freelancers, gig workers, independent contractors, and small business owners. The very freedom that makes entrepreneurship so appealing, being your own boss, also brings with it a host of financial responsibilities, with taxes being the most significant. Today, we'll explore why this group faces unique challenges and how to navigate them. As we delve into business-related tax topics, it is especially important to remember that this content is for educational purposes. Business tax law is incredibly complex, and the right strategy for one business may be wrong for another. Always seek advice from a qualified tax professional who can analyze your specific business operations. The fundamental difference for a self-employed person is this: there is no employer to handle taxes for you. When you work a traditional W-2 job, your employer withholds a portion of your income from each paycheck for federal income tax, state income tax, Social Security, and Medicare, and sends it to the government on your behalf. When you are self-employed, you are both the employer and the employee. You are responsible for calculating and paying all of those taxes yourself. This is done through a system of estimated tax payments. Because the U.S. has a pay-as-you-go tax system, you are required to pay taxes on your income as you earn it throughout the year, not just in one lump sum in April. For the self-employed, this means making quarterly payments to the IRS. These payments must cover not only your income tax but also your self-employment tax. This is a common point of surprise and distress for new entrepreneurs. The self-employment tax covers your contributions to Social Security and Medicare. A W-2 employee pays half of this, and their employer pays the other half. A self-employed person must pay both halves, which currently amounts to a rate of 15.3% on the first portion of your net earnings. The primary pitfall here is the discipline of setting money aside. When you receive a payment from a client, it's easy to see that as 100% your money, but in reality, a significant portion, often 25 to 40% or more, depending on your income level, needs to be set aside for taxes. When income is irregular and expenses are unpredictable, it can be incredibly difficult to know exactly how much to pay each quarter, often leading to underpayment and a shocking tax bill at the end of the year. Beyond estimated taxes, there are other common traps. One of the biggest is commingling funds. This means using the same bank account for all your business and personal transactions. While it may seem simpler, it creates a bookkeeping nightmare. It becomes nearly impossible to accurately track your business expenses, which means you will miss out on legitimate deductions. Every missed deduction means your net income is higher than it should be, and you end up paying more tax than you are legally required to. This leads to the next point: inadequate record keeping. To lower your tax bill, you must meticulously track every business-related expense, from office supplies and software subscriptions to mileage and a portion of your home office costs. Without proper records and receipts, you cannot legally claim these deductions. When these issues spiral, a self-employed person can find themselves with a significant tax debt that feels personal, but is legally tied to their business. The solutions we have discussed in previous chapters, installment agreements, offers in compromise, and CNC status are all available for business-related tax debts. However, the process can be more complex, as the IRS will scrutinize both your personal and business finances. This is why, for the self-employed, a tax professional is not just for crisis management. They are a partner in prevention. A good advocate or accountant can help you calculate accurate quarterly payments, set up a simple bookkeeping system to keep your finances separate and organized, and ensure you are taking every legitimate business deduction you are entitled to. An investment in professional tax help early on is one of the wisest investments a small business owner can make. Hello and welcome back. In our last chapter, we focused on the unique challenges of the self-employed. Today we take the next step and discuss an issue that affects business owners with employees. While all tax debts are serious, there is one category that the IRS pursues with the most tenacity and the harshest penalties: unpaid payroll taxes. If income tax debt is a serious problem, payroll tax debt is a five-alarm fire. Today we will explain what makes this debt so different and why the consequences can be so severe, not just for the business, but for individuals as well. Given the gravity of this topic, our standard disclaimer is more important than ever. This is a complex and high-stakes area of tax law. The information provided is for educational purposes only, and is not a substitute for immediate consultation with an experienced tax attorney or other qualified tax professional. So, what makes payroll tax so different? The answer lies in a simple concept: trust. When you run a business with employees, you act as a collection agent for the government. From each employee's paycheck, you withhold their federal income taxes, their share of Social Security, and their share of Medicare taxes. This money never, at any point, belongs to the business. You are simply holding it in trust for your employees and the U.S. Treasury, with the legal obligation to remit it to the government on a set schedule. The IRS refers to these withheld amounts as trust fund taxes. Payroll tax problems almost always start with a cash flow crisis. A business owner is faced with a difficult choice. Do I pay a critical supplier to keep the doors open, or do I make the payroll tax deposit? Many will choose to pay the supplier thinking, this is just a temporary loan. I'll catch up with the IRS next month. But this decision is a catastrophic mistake. It's not borrowing from the IRS. In their eyes, it is spending money held in trust, which is a serious violation. This often creates a dangerous cycle, where the debt from one period snowballs into the next, and a manageable problem quickly becomes an overwhelming crisis. Because the IRS considers this a breach of trust, the consequences are far more severe than for other types of tax debt. The most powerful tool they use is the Trust Fund Recovery Penalty, or TFRP. This is the mechanism that makes payroll tax debt so uniquely dangerous. The TFRP allows the IRS to pierce the corporate veil. This means that the protections of an LLC or a corporation are meaningless here. The IRS can and will assess the trust fund portion of the debt, the money withheld from employees, personally against any individual they deem to be a responsible person. The definition of a responsible person is intentionally broad. It's not just the owner or CEO. It can be a partner, a corporate officer, a bookkeeper, or anyone who had significant control over the company's finances and the power to decide which bills got paid. To assess the penalty, the IRS must simply determine that this responsible person willfully failed to pay the taxes. In this context, willfully does not mean with evil intent. It simply means the person was aware of the outstanding taxes and chose to pay other creditors instead of the government. This means that if your business owes $200,000 in payroll taxes, the IRS can come after your personal assets, your home, your savings, your car, to satisfy that debt. This personal liability is relentless and is generally not dischargeable in bankruptcy. So what can be done? The first, non-negotiable step is to achieve current compliance. A tax advocate's immediate goal will be to get all delinquent payroll tax returns, such as Form 941, filed and to ensure the business starts making all of its current tax deposits on time and in full. The IRS will not discuss a resolution for past due taxes if the business is still falling behind on its current obligations. Once compliance is achieved, an advocate can explore solutions, such as negotiating an installment agreement for the business to pay back the full amount over time. They can also represent individuals during the TFRP investigation, arguing the case, and if the penalty is assessed, negotiating a separate payment plan for that personal liability. In conclusion, payroll tax debt is an emergency. It is the one area where the IRS shows the least flexibility and takes the most aggressive action. If you or someone you know is facing this issue, the time to act is now. Hello and welcome back. There are few words from the IRS that can cause as much immediate anxiety as the word audit. For many, it conjures up images of a stressful, invasive examination. While an audit is a serious matter that requires your full attention, it is not a random attack. It is a structured, procedural review. The goal of this chapter is to pull back the curtain on the audit process, explain what it really is, and show how it can be navigated effectively, especially with professional help. First and foremost, it's important to understand that being selected for an audit is not an accusation that you've done something wrong. It is simply a request for verification. A critical security note before we begin. An IRS audit is always initiated by an official letter sent through the mail. The IRS will never begin an audit with a surprise phone call, an email, or a message on social media. If you receive such a contact, it is almost certainly a scam. As with all chapters in this series, this information is for educational purposes. An active audit requires personalized advice and strategy from a qualified tax professional who can represent you. The audit notice. An audit begins with that official letter. This notice will be your roadmap. It will clearly state which tax year or years are being examined. It will also specify which parts of your tax return are under review. An audit is rarely a review of your entire return. More often, the IRS is interested in verifying a specific item, like business expenses claimed on a Schedule C, large charitable donations, or rental property income and losses. The notice will also inform you of the type of audit being conducted. There are three main types of audits, ranging from simple to complex. Correspondence audit. This is the most common and least intrusive type. As the name suggests, it is handled entirely by mail. The IRS will request documents and records to support a specific item on your return. You, or your representative, will then mail copies of the requested information. There is no in-person meeting. Office audit. This is a step up in intensity. You or your representative will be asked to visit a local IRS office to meet with an auditor. The scope of the audit is still typically limited to the items listed in the original notice. At the meeting, the auditor will ask questions and review your documentation in person. Field audit. This is the most comprehensive type of audit. An IRS revenue agent will visit your home, your place of business, or your representative's office to conduct a thorough examination of your books and records. Field audits are generally reserved for more complex individual returns or business returns. The role of a tax advocate. Regardless of the audit type, your right to retain representation, which we discussed in a previous chapter, is your single most powerful tool. You do not have to face an auditor alone. Hiring an enrolled agent, a CPA, or a tax attorney can fundamentally change the dynamic of the audit process. First, your advocate acts as a buffer. Once you sign a power of attorney, the IRS must communicate with your representative, not with you. This immediately reduces your stress and anxiety. Your advocate will handle all letters, phone calls, and meetings. Second, they ensure strategic preparation. An experienced professional knows exactly what kind of documentation the IRS is looking for and how to present it in a clear, organized, and professional manner. They will review all your records before they are sent to the auditor to ensure everything is in order. Third, they manage the scope. A key job of a representative is to keep the audit focused on the original items listed in the notice. Auditors may sometimes ask questions that could lead to other parts of your return, an issue known as scope creep. An advocate knows how to politely but firmly keep the examination confined to its intended purpose. The audit's outcome. After the auditor has reviewed your information, there are three possible outcomes. No change. The auditor accepts your return as it was filed, and the audit is closed. Agreed. The auditor proposes changes to your tax return, resulting in you owing more tax, and you agree with the findings. You will sign an examination report, and the IRS will send you a bill for the tax, penalties, and interest. Disagreed. The auditor proposes changes, and you do not agree with their findings. This is not the end of the line. You have the right to appeal, which allows you to take your case to the IRS Office of Appeals, an independent division within the IRS, to seek a resolution. An audit is a process that can be managed. With professional representation, it is a matter of procedure and documentation, not fear and confrontation. Hello and welcome back. For millions of married couples across the United States, filing a joint tax return is an annual ritual. It's often simpler and usually results in a lower tax bill than filing separately. However, signing that joint return comes with a legal reality that many people are unaware of, a concept known as joint and several liability. This means that both spouses are legally on the hook for 100% of the tax, penalties, and interest due on that return, regardless of who earned the income or who made the mistake. The IRS can collect the entire amount from either spouse. But what happens when this rule becomes deeply unfair? What if one spouse intentionally hid income or claimed deductions they weren't entitled to, all without the other spouse's knowledge? For these situations, the IRS has created a set of crucial protections known as innocent spouse relief. Today, we will explore this vital remedy, which can sever one spouse's responsibility for a tax debt they had no part in creating. As we discuss this sensitive topic, please remember that these cases are extremely fact-specific. This information is for educational purposes only, and you must consult with a qualified tax professional to understand if these rules might apply to your individual circumstances. At its core, innocent spouse relief is designed to address situations where it would be fundamentally unfair to hold one person liable for the tax errors of their spouse or former spouse. To achieve this, the IRS has created 3 distinct types of relief that can be requested. The first is what we'll call classic, innocent spouse relief. To qualify for this, you must meet several strict conditions. First, you must have filed a joint return that has an understatement of tax, meaning more tax was due than was reported. Second, this understatement must be due to erroneous items from your spouse or former spouse, such as unreported income or incorrect deductions. Third, and most critically, you must be able to prove that when you signed the tax return, you did not know, and had no reason to know, about the error that caused the understatement. Finally, considering all the facts and circumstances, it must be inequitable or unfair to hold you liable. The second type is separation of liability relief. This form of relief is available for taxpayers who are no longer married, are legally separated, or have lived apart for at least 12 months. Unlike classic innocent spouse relief, which can erase the liability, this relief divides the tax liability. The understatement of tax is allocated between you and your former spouse as if you had filed separate returns. You would then only be responsible for the portion of the tax debt allocated to you. The third and most flexible category is equitable relief. This is a fallback option that can apply when you don't qualify for the other 2 types of relief, but it would still be unfair to hold you liable. Equitable relief is broader. It can apply not only to tax understatements but also to underpayments, situations where the tax was reported correctly, but the bill was never paid. The IRS looks at a long list of factors to determine eligibility, including if you are a victim of spousal abuse or financial domination, if you would suffer significant economic hardship, and if you had any reason to believe the tax would not be paid. Requesting this relief is not an automatic or simple process. You must formally apply for it by filing IRS Form 8857, Request for Innocent Spouse Relief. This form is not just a series of checkboxes. It requires you to build a detailed and persuasive case. You must provide evidence and a written narrative that explains your situation and demonstrates how you meet the strict criteria for one of the relief provisions. This is where a tax advocate's experience is invaluable. They can help you determine which of the 3 types of relief you are most likely to qualify for. They know what factors the IRS considers most important and can help you gather the necessary documentation and craft a compelling story that addresses each of those points. It is also important to know that when you file for this relief, the IRS is legally required to contact your spouse or former spouse, who will have the right to participate in the process. Navigating this can be emotionally difficult, and having a professional representative manage the proceedings is often essential. In conclusion, innocent spouse relief is a just and necessary protection, but it is a complex legal process with a high burden of proof on the person requesting it. Hello and welcome back. Imagine this scenario. After a period of financial hardship, you successfully negotiate with a credit card company to settle your $10,000 debt for just $4,000. The remaining $6,000 is forgiven. It's a huge relief. You've put the problem behind you. Then, the following January, you get a strange form in the mail from that same credit card company. It's a Form 1099-C, and it seems to be telling the IRS that you received $6,000 in income.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
This can be a confusing and alarming moment for many people. Today, we are going to unravel this mystery and explain the concept of cancellation of debt income. As we navigate this counterintuitive topic, please remember that this is an educational overview. The rules surrounding this issue, especially the exceptions, are complex and require a careful analysis of your financial situation by a qualified professional. So why on earth is a forgiven debt considered income? The logic from the IRS's perspective is fairly straightforward. When you initially borrowed the money, you didn't have to pay taxes on it because you had a legal obligation to pay it back. When that obligation is canceled, you have an accession to wealth. In the eyes of the tax code, you are $6,000 richer than you were before the debt was forgiven, because that is money you received but no longer have to pay back. Therefore, it is generally treated as taxable income. This is where Form 1099-C, cancellation of debt, comes in. Federal law requires lenders, such as banks and credit card companies, to issue this form whenever they cancel a debt of $600 or more. One copy goes to you, and another copy goes directly to the IRS. This is a critical point. The IRS knows about this income. Simply ignoring the form is not an option, and will almost certainly trigger an automatic underreporting notice, along with penalties and interest. Now for the good news. Just because you receive a 1099-C does not automatically mean you will have to pay tax on that amount. There are several important exceptions and exclusions. The most common of these is the insolvency exclusion. Insolvency is a financial state, not a feeling. For tax purposes, you are considered insolvent if, immediately before the debt was canceled, the total of all your liabilities, what you owed, was greater than the fair market value of all your assets, what you owned. For example, if you had total debts of $50,000 and your assets were only worth $30,000, you would be insolvent by $20,000. This means you could exclude up to $20,000 of canceled debt from your income. You are only required to pay tax on any forgiven amount that exceeds the amount by which you were insolvent. Another major exclusion is for debts discharged in a Title 11 bankruptcy case. If your debt was canceled as part of a formal bankruptcy proceeding, it is not considered taxable income, and you can exclude the full amount. There are other, more specific exclusions as well, for things like qualified principal residence indebtedness, qualified farm debt, and certain student loans. But insolvency and bankruptcy are the most common protections for individuals. Even if you qualify for one of these exclusions, you cannot simply throw the 1099-C away. You must proactively claim the exclusion on your tax return. This is done by filing another form, IRS Form 982, Reduction of Tax Attributes Due to Discharge of Indebtedness. On this form, you report to the IRS why you are excluding the canceled debt from your income. A tax advocate plays a crucial role here. They can perform a detailed insolvency calculation, a balance sheet of your assets and liabilities, to determine if you qualify for the exclusion and by how much. They will then prepare Form 982 correctly and file it with your tax return, ensuring you have the documentation to protect you from that surprise tax bill. Hello and welcome back. Our series has covered a wide range of tax problems and solutions, many of which are triggered by major life events. There are few events more significant and challenging, both emotionally and financially, than a divorce. While navigating the legal and personal aspects of a separation, the tax implications can often be overlooked, leading to costly surprises down the road. Today, we will provide a general overview of the 3 key financial areas in a divorce: alimony, child support, and property division, and their associated tax rules. Before we proceed, it is absolutely essential to state that this chapter is for informational purposes only. It is not legal or tax advice. Divorce is a complex legal proceeding, and you must consult with a qualified family law attorney for legal guidance, and a tax professional for advice on your specific financial situation. Let's begin with alimony, also known as spousal support. This is the area that has seen the most significant changes in recent years. The tax treatment of alimony payments is now determined by a single, critical date: the date your divorce or separation agreement was executed. For any divorce agreement executed on or before December 31st, 2018, the traditional rules apply. Under these rules, alimony payments were deductible by the person paying them, the payer, and they were considered taxable income to the person receiving them, the recipient. However, the Tax Cuts and Jobs Act of 2017 completely reversed this. For any divorce agreement executed on or after January 1st, 2019, the new rules apply. Under these new rules, alimony is not deductible by the payer, and it is not considered taxable income for the recipient. For tax purposes, these payments are now treated as a neutral transfer of funds, much like a gift or child support. This is a monumental shift, and it is crucial to understand which set of rules governs your specific agreement. Next, let's discuss child support. The tax treatment of child support is much more straightforward and has not changed. The rules are simple and absolute. Child support payments are never tax-deductible for the parent who pays them, and they are never considered taxable income for the parent who receives them. It is a completely tax-neutral transfer intended for the care of the child. It is also important to note that the divorce decree will typically specify which parent has the right to claim the children as dependents on their tax return, which is a separate but valuable tax benefit. Finally, we have the division of property. When a couple divides their marital assets, such as a house, stocks, or bank accounts, the transfer of that property between them as part of the divorce is generally a non-taxable event. For instance, if one spouse transfers the full title of the marital home to the other, no capital gains tax is due at that time. However, there is a critical concept to understand here called cost basis. The original cost basis of the asset transfers along with the property. For example, let's say a couple bought a home together for $200,000. Years later, during a divorce, the house is worth $500,000. One spouse transfers their share to the other. The spouse who now owns the house retains the original cost basis of $200,000. If they decide to sell the house a year later for $520,000, they will be responsible for the capital gains tax on the entire $320,000 of appreciation, not just the gains since the divorce. A tax advocate's role in a divorce is not to provide legal advice, but to work alongside the family law attorney. They help clients understand the long-term, after-tax value of various settlement proposals. $100,000 in a pre-tax 401k is not worth the same as $100,000 in a savings account. A tax professional can illuminate these crucial differences, helping to ensure that a settlement is truly fair and equitable in the long run. Hello, and welcome back for the final chapter of our comprehensive guide. We began this journey together with the unsettling feeling that comes from an official IRS notice. Over 14 chapters, we have traveled from that moment of anxiety to a place of knowledge and empowerment. We've identified the professionals who can help, explored the full range of solutions from payment plans to debt settlement, understood the serious consequences of inaction, and navigated the complex tax implications of major life events. Our goal for this final session is to bring all these lessons together and provide a clear, positive roadmap for building a healthy tax future. Before we conclude, allow me to share our most important reminder one last time. This entire series has been produced for educational and informational purposes only. It is not and has never been a substitute for personalized legal, financial, or tax advice from a qualified and licensed professional. We hope it has given you the confidence and vocabulary to seek out and engage with that advice effectively. As we look to the future, maintaining long-term tax health can be distilled into 3 fundamental pillars. The first and most important pillar is proactive record keeping. So many tax problems, from audits to missed deductions, stem from disorganized or non-existent records. Good record keeping is not a chore to be done a week before taxes are due. It's a simple, ongoing habit. For individuals, this can be as easy as having a dedicated folder for tax documents. For the self-employed, it is non-negotiable. Use modern software, maintain a separate bank account for all business activity, and diligently track your income and expenses. Good records are your best defense in an audit, and your best tool for ensuring you only pay the amount of tax you are legally required to owe. The second pillar is understanding your obligations. You do not need to become a tax expert, but you should understand the basics that apply to your situation. If you are self-employed, the concepts of quarterly estimated payments and self-employment tax must be part of your financial DNA. If you hire employees, you must understand the sacred responsibility of handling trust fund taxes. Knowledge of these fundamentals allows you to spot potential issues long before they become major crises. The third and final pillar is seeking professional help early and often. Throughout this series, we have discussed the role of tax advocates primarily in the context of solving existing problems. But their greatest value often lies in prevention. Engaging a professional for a consultation or for annual tax planning is not an admission of failure. It is one of the smartest investments you can make in your financial well-being. It is the difference between paying for a diagnosis and checkup versus paying for emergency surgery. An enrolled agent, CPA, or tax attorney can provide the clarity and strategy to keep you on the right path from the very beginning. Ultimately, our goal has been to encourage a fundamental shift in mindset, from viewing taxes and the IRS with fear, to viewing them as a manageable part of your financial life. The system is complex, but it is based on rules, procedures, and laws. It even has provisions for hardship and fairness. By being proactive, organized, and willing to ask for help, you change the dynamic from one of uncertainty to one of control. Thank you for joining us on this journey. We hope this series has provided you with the knowledge and confidence to face any tax situation, not with anxiety, but with a clear understanding of the path to resolution. We wish you the very best in building a secure and prosperous financial future.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.